planning on purchasing a house in Maryland, Delaware, New Jersey, Pennsylvania, or Virginia, and looking for a no down payment mortgage loan with no monthly private mortgage insurance costs, with the interest rate comparable to a conventional loan? At Millennial Home Loans, we offer this loan option. Stay tuned, I'll tell you all about it. Hi, my name is David Zuckerman. I am a mortgage broker at Millennial Home Loans. Millennial Home Loans is licensed in Maryland, Pennsylvania, and Virginia, and I personally specialize in originating low to no money down payment mortgage loans. Today I'm going to talk about one of the most unique loan programs that I've just started offering. This loan program is a game changer by allowing home buyers, such as yourself, the ability to purchase a house with zero down payment and no monthly private mortgage insurance costs. Best of all, the loan program offers an interest rate comparable or lower than a standard conventional mortgage loan interest rate. This loan program is a conventional mortgage loan based upon Fannie Mae's Home Ready Mortgage Loan Program guidelines. The loan program is structured as a combination of an 80% first mortgage and a 20% community second mortgage. By example, if you have a $400,000 purchase price, the first trust mortgage lien will be $320,000, and the second trust lien will be $80,000, for a total finance loan amount of $400,000 and zero down payment required. This is known in the mortgage industry as an 80-20 loan. Both the first and second mortgage loans are 30-year fixed-rate mortgages with identical interest rates. This loan program is available to first-time home buyers, non-first-time home buyers, and even current homeowners that want to purchase a new property and keep their current home and convert it to a rental property. By structuring the loan program as an 80% first mortgage and a 20% second mortgage, there is no monthly mortgage insurance required, providing buyers with a lower monthly mortgage payment, and no down payment requirements, which eliminates a minimum 3 to 5% down that normally is required on a conventional loan, or the 3.5% down payment required on an FHA loan. The 80-20 loan program requires that the borrowers on the loan application complete a free online homeownership class, obtain an automated underwriting system or AUS approval recommendation, and the incomes on the loan application can't exceed 80% of the area median income or AMI. This is based upon the property address that's being purchased. By using just the income listed on the loan application, there is no household income analysis, and the reported income can exclude portions of your income if not needed to qualify for the loan. The area median income criteria is a very important aspect of the loan program, and I'll do a deep dive into this topic later in the presentation. Other important aspects of the 80-20 loan program are as follows. Your debt-to-income ratio can be as high as 50% of your gross monthly income based upon the AUS findings. Furthermore, if you are a well-qualified borrower, there isn't any allocation of debt load differentiating between the housing expense and the total expense, which is known as the front-end and back-end ratios. In other words, your front-end and back-end ratios could both be as high as 50% of your gross monthly income. And I have closed multiple transactions in which the monthly mortgage payment is 50% of the gross monthly income. The seller can contribute up to 3% of the purchase price to offset the closing costs. The property you're purchasing must be your primary residence and cannot be used as an investment property or second home property until after you've lived in the property for at least 1 year. Allowable property types include single-family homes, townhomes, and agency-approved condominiums. Manufactured homes are permitted with a 5% down payment. Your minimum credit score requirements are 620 for all applicants on the loan. However, I will add from my own firsthand experience, to obtain the appropriate approval levels through the AUS, the lowest middle credit score ideally will be in the upper 600 range or preferably higher. If a borrower on the loan application does have a credit score that is between 620 and 680, ideally they will be able to document significant assets or have a co-applicant with higher credit scores. Non-occupant co-signers are allowed on the loan, but their income must be included when determining the total combined income of the loan application, which again must be less than 80% of the area median income. This loan program is available for residential home purchases throughout all of Maryland, Pennsylvania, Virginia, New Jersey, and Delaware. I think it's really important to discuss how does this program benefit you. One of the greatest concerns for first-time homebuyers is saving up for the down payment. With zero down payment, this program can be the difference between you being able to start a home search now or having to wait until you have saved up the minimum 3, 5, 10% down payment that you think is required. This is powerful. I think it's important to discuss the affordability achieved through the 80/20 loan program. For starters, you no longer have to pay a monthly mortgage insurance premium. This means you're most likely will be able to achieve a total lower monthly mortgage payment when compared to a standard Fannie Mae Home Ready or Freddie Mac Home Possible first-time homebuyer loan, or even a standard low down payment conventional loan. Even though the finance loan amount is going to be lower on these types of loans, since they all require a minimum 3% down payment, whereas the 80/20 loan program requires a 0 down payment. Now, I want to switch gears and talk about payment shock. If your current monthly housing costs, whether you're living rent-free with your parents or paying rent, but often at a lower monthly cost than your anticipated new mortgage payment will be, you experience what is known as payment shock. Simply put, payment shock is the difference between your current housing expense and your new mortgage payment. If this is a concern of yours and you're starting to ask yourself, will I be able to afford this house? Well, that's a really valid concern. Consider it just for a moment. What if you no longer are putting the money you saved toward a down payment into the mortgage, but rather toward paying off other debts that you have, whether it's a installment loan such as a car loan or personal loan or credit card debt? I can't tell you how many times I've asked my clients to consider putting less money into the down payment and instead pay off their other debts that they have going into the home buying process, such as a car loan or an installment loan. The bottom line is there'll be less of a financial burden when you're having to make that new mortgage payment if you don't have those other monthly liabilities hanging over your head. While we're talking about paying down debt in conjunction with purchasing a house, what if you're in the process of shopping for a house but can't find a house that you could truly get excited about, based upon the maximum purchase price or the monthly payment that you've been approved for? If you're in this situation and feel comfortable with a larger mortgage payment, but feel you must settle for a home based upon the amount of the loan approval, there is another perspective on paying down non-mortgage debt to achieve your goal of buying a house that you really like. By paying down non-mortgage debt, you may be able to increase your maximum monthly payment that you could qualify for on a dollar-for-dollar basis based upon the consumer debt that gets paid down at the settlement table. For example, if you have a car loan with a $500 monthly payment, there is a good chance you can increase your maximum monthly mortgage payment by the identical $500. Just think about a debt that you can pay off instead of putting money into the down payment and how much additional house that you now may be able to afford. Or perhaps you find other better uses for the down payment, such as making home improvements or repairs to your new house after settlement, or buying furniture or other household items for your new home. I want to talk about the efficiencies of the 80/20 loan program compared to other loan programs. To start off with, anyone who's been approved for any other low down payment loan solution, especially if it's a 3% down Home Ready or Home Possible loan, please feel free to reach out to me about the benefits of the no money down payment loan solution that I'm offering versus the current loan program you've already been approved for. I will gladly show you the monthly payment and cash to close savings achieved through this no money down loan option compared to your current Home Ready or Home Possible loan program. Now, if you've already been approved for a government loan such as FHA, VA, or USDA, these are all great loan programs, and I've helped a lot of clients achieve homeownership and build financial wealth using these types of government loans. The one thing that these loan programs all have in common, though, is that for the most part, they have upfront fees that are financing the loan and usually monthly payment surcharges that resemble private mortgage insurance or PMI, but unlike PMI, last for the life of the loan, all 30 years of it. These finance upfront fees and, where applicable, monthly fees, assuming the minimum down payment required based upon a 30-year fixed rate mortgage, are as follows. FHA loans. The upfront mortgage insurance premium is 1.75% of the loan amount. This is financed into the loan, but still is going to cost you 1.75%. And there's a monthly FHA annual mortgage insurance premium, which is going to be based upon a factorial of 0.55 for the life of the loan. VA loans. The funding fee is as low as 2.15% of the purchase price of the house for first-time use, and goes up all the way to 3.3% for all subsequent use of the VA loan. Now, if you have a VA loan approval and are receiving VA disability income that will allow the upfront funding fee to be waived, your current VA loan option is probably your most optimal loan program. USDA loans. The USDA loan guarantee fee is 1% of the loan amount, again, financed into the loan, and a monthly annual fee based upon a factor of 0.35% of the life of the loan. If you've been approved for any of these government loan options, it may be worthwhile to consider how the 80/20 loan program compares against these loan options. Now, there is one final group of home buyers I want to touch upon who may really benefit from the efficiency of the 80/20 loan. Earlier in the presentation, I mentioned that this program allows a home buyer to own one other property. This could be an existing investment property or the current primary residence that the home buyer wants to convert from a primary residence to an investment property. If you already own a home, especially if you have a very low interest rate and are looking to buy another home and want to retain ownership of your current home as a rental property, this loan program permits you to retain your current house and even allows a portion of the anticipated rental income to be used as an offset against your departing resident's current mortgage expense, which is important when calculating the new debt to income ratio. And don't forget, by using the 80/20 loan program, you could avoid any down payment requirements, making the 80/20 loan a great tool that allows you to take advantage of your existing mortgage loan's ultra low interest rate while laying a foundation toward building multi-generational wealth. Now, let's jump forward and say you're now ready to make an offer on a property, and your realtor tells you there's going to be a lot of interest on this house, and the sellers are anticipating multiple offers. Let's say you have saved up your down payment, but need the seller to pay your closing costs via seller-funded closing cost assist. Your realtor will probably let you know that this is going to make your offer less attractive when compared to other offers that aren't requesting closing cost help. With the 80/20 loan program, you can take the money that you're planning on putting toward a down payment and apply that to your closing costs instead, which means you no longer are having to ask for as much closing cost help or perhaps any closing cost help at all. This will increase the chance of having your offer accepted by the seller. Another consideration when fighting to have your offer accepted by the seller is the loan type. If your loan is a government-backed loan such as FHA, VA, or USDA, the appraisal report serves two purposes. One, establish the value of the property. Two, to list any safety and livability repairs that must be made prior to closing on the loan. This is different from a conventional loan such as the 80/20 loan program, in which the appraisal report for the most part will be used just to establish the value of the property. Now, I'm not saying that it's a bad thing to have the seller make repairs to a property before you close on the transaction, but if you're competing against other offers and really want the house, your realtor may let you know that your offer may not receive as much interest from the seller compared to conventional loan financing because of this issue. Now, as promised, I want to talk further about area median income, or AMI. Let me now show you how to look up the AMI associated with the property address. Starting from your Google toolbar, type in area median income lookup. Note the Fannie Mae as well as the Freddie Mac lookup tools appear. In this case, we're going to use the Fannie Mae area median income lookup tool. And at that point, select the disclaimer. And we're going to enter a property address. I'm going to enter a random address, 1600 Pennsylvania Avenue in Baltimore, Maryland. Note that this block is going to appear. The 80% area median income lookup will be indicated at $97,760. That's all you have to do in order to look up the area median income for a specific property. This amount represents the maximum income that the 80/20 loan will allow for this particular property address. Should your household income, your total income, or the combined income of you and any other borrowers on the loan application exceed this amount, you still may be able to qualify for the 80/20 loan program. Here's how. The 80/20 loan program determines the AMI based upon the income listed on the loan application. This means that elements of your income, and if applicable, a co-applicant, can be excluded from the loan application. Bottom line, there is flexibility on how to structure this loan program based upon using just the income listed on the loan application. Always keep in mind that the income listed on the loan application must be accurate and truthful. So if the borrower's income is $80,000, that's their base income, is $80,000. That is the amount that must be listed on the loan application, and not an amount lower than $80,000 just to meet the AMI threshold guidelines. Look, I know I covered a lot today with a lot of information to consider. If you think this 80/20 loan program can be beneficial to you, as a full-service mortgage broker with hundreds and hundreds of 5-star Google and Zillow reviews, I'll be more than happy to run loan scenarios for you so that you could determine your optimal loan strategy based upon different down payment options and different loan products, so you can decide which loan program is right for you. And if you're in the very early stages of the home buying process and right now just want to run monthly payment scenarios on your own, I have provided links in the description section listed below using different monthly payment calculators for the 80/20 loan, conventional, FHA, VA, USDA loan programs as well. And when you are ready to move forward, please keep me in mind. And as always, if you find this video helpful, please don't forget to hit the like button and make sure you subscribe to this channel so you don't miss my next video on unique and niche loan programs, guidelines, and loan scenarios.